Last week, Apple announced that they are splitting their stock 4-to-1. Had a question from a couple of you about what that means for the stock. So we're going to talk about that today. Here's the question I got from Eric. He says, "Hi Nathan, I was just reading your latest email regarding shareholder yield. Can you talk about the Apple stock split and how that relates to share dilution? Does this help or hurt shareholder yield?" Thanks, Eric. Great question from Eric. So we're going to talk about, first of all, what is a stock split? How does the stock split impact a stock's future performance? And then we're going to look specifically at the most recent Apple 4-for-1 split. We're going to talk about why they went up 10% on the announcement date, why the investors will actually be selling $1.8 billion worth of Apple later this month. Talk about that. And then also, what does this mean for Apple's future and their fundamentals? Talk about that at the end of the video. First of all, what is a stock split? Let's say we have a hypothetical business that you own half of. So you own 50%, and let's say your neighbor owns the other 50%. And you each own 1 share. So there's a total of 2 shares in this company, and you decide to do a stock split. We'll say you do a 10-for-1 stock split. So what you're going to do is take the number of shares that the business has and multiply that by 10. So now you're going to have 20 shares instead of 2. However, each one of you will still own 50% of the business. All that's going to happen is that you are going to now have 10 shares, and the other person will also have 10 shares. And the business itself is not going to be worth any more or less because you created these new shares. Value of your ownership will be unchanged, and that's the same with a public stock split. It does not affect or should not affect the share price. However, in practice, that can happen. So we'll talk about that in a second. So like we talked about Apple's 4-for-1 split, this is basically what's going to happen. So they're going to split on, I think it's August 28th. Every 1 share that you own of Apple is going to become 4 shares. And so if we just simply calculate what will happen, so right now the stock price is $4.40. If the split happened today, it would take $4.40 divided by 4, gets us to $110 per share. That's what the per share price would fall to. However, you're now going to have 4 shares instead of 1, so your total value will then be $440, just like it was before the split. So Eric's question was, how does that affect shareholder yield? And it's a good question because it seems as though Apple is issuing shares, and technically they are. The difference is that in a dilution scenario, you're actually bringing in outside investors, so your percentage of the business is declined a little bit. In a stock split scenario, it's just cosmetics, so there's not actually any reduction in the percentage of Apple's stock, or Apple's company that you own. As far as how this looks on fundamentals, it really doesn't have any effect at all. So as we talked about, the market value before the split and after the split is exactly the same. The market cap is going to be unchanged, so the number of shares that Apple has outstanding will be multiplied by 4. The per share price will be divided by 4, so that'll be unchanged market cap. Net income will be unchanged, dividends will be unchanged, and then the data providers will adjust all of the data in the past to reflect the new share price, so you can still compare how much stock did this company buy back over the last 12 months for shareholder yield, or how much does the dividend grow. You can calculate all that data even post-split. So if it doesn't matter for the share price, why would a company do it? So the boilerplate answer is that it allows more investors to participate in the stock. So if you've got a $100,000 per share stock price, you have to have at least $100,000 in order to buy one single share. So this limits the amount of people that can buy the stock to a very small amount of high net worth investors. So in this case, the theory goes that if you split this, so in this case, if you'd split this 1,000 to 1, basically you would end up with a share price of $100 instead of $100,000. The value of the company would be unchanged. It's just that you're able to buy a smaller fraction of the business with $100. So that opens the door to more investors. The real reason, however, I think most companies do it, is that it makes their stock go up, or at least research suggests that it does. So there's a study in 1996 that found that stocks that split their shares actually beat the market by 7.9% over the next year and 12% over the next 3 years. So companies split their stock because they think it's going to result in them having better performance. However, that does not seem to be the case in more recent years. Mark Hulber did a study published a couple days ago where he looked at the total return of stocks that had done a 2-for-1 stock split, and he compared that to the Wilshire 5000 Total Return Index. And what you can see with this, so this blue line shows the performance of the 2-for-1 index. So the stocks that have split have outperformed the broader market since 1996. However, this is in log format, so you can see that really since about here, this distance has not expanded at all throughout the years. It's basically the same now as it was back here, which suggests that all of the outperformance of this strategy came right here. And since then, there really has not been any outperformance from stocks that have split versus those that have not. And that's reflected in the ways companies are splitting or not splitting recently. So in the S&P 500, Hulbert found that in 2011, there were 20 stocks that had a stock price, a per share stock price of greater than $100. So the vast majority of companies, 479 of the 500 companies had a per share stock price below 100. 20 had a stock price above 100, and only one stock had a share price above 500. 2020, and it's a vastly different situation. Very few companies have split their stock price, so we've ended up with a lot of extremely high per share prices. Now there are 211 companies with stock price greater than 100, 16 with stock price greater than 500, and 7 stocks with stock price greater than 1,000. Of course, a lot of this has to do with the bull market since 2011, but a lot of it also has to do with companies no longer splitting their stocks. So the question then is, why was Apple up 10% on the announcement date? There's been a couple headlines I've seen where people will talk about how the shares of Apple jumped 10% since announcing the 4-for-1 stock split. So basically they're, in this case, attributing the 10% gain in Apple's stock price to its stock split. However, keep in mind the stock split was announced on an earnings date. So the real reason why Apple did so well, the stock, is not because they split the shares, but because their numbers were absolutely fantastic. So that Q3 2020 report, Apple had revenue plus 11, earnings plus 18. That compared to expectations negative. So they absolutely blew away investor expectations. That's what drove the stock higher, not the stock split. So in this next section, I want to talk just for a couple minutes on why this stock split could hurt their stock price a little bit. And the reason is because Apple is in the Dow Jones Industrial Average. The Dow Jones, unlike the S&P 500, is not weighted by market cap. So it's not weighted by the overall value of the company. It is weighted by the price of the stock. It's a very illogical way to weight a portfolio, but that's the way it is. That's the way it's always been. So on the left here is the current Dow Jones weighting. This is the estimated post-Apple stock split weighting. So you can see that Apple right now is the #1 weighting in the Dow because they have the highest per share stock price. So that corresponds to a weighting of 11.14%. So if you just add up all the current weighting of all of the 30 components and then divide 441 by that total, you get 11.1. So this is what the Dow ideal weighting in Apple should be at the moment. Once they do the stock split, their stock price is going to drop to roughly 110 if it happened today, which means their their total weighting in the Dow is going to go from 11.1 to 3.04. And that means that on the date of the next rebalance for the Dow, they're going to reduce the weighting in Apple, and that means that all the ETFs that track the Dow are also going to sell Apple stock. So how much is that going to affect the stock? Let's look here. This is the Dow Jones Industrial Average ETF by iShares. This is the largest Dow Jones ETF. They have an assets under management of around $22 billion. So in this example, we would say, okay, Apple is going to go from a weighting of 11.14%. That's going to go down to 3.04%. So if we multiply this assets under management by these two numbers, we come up with 2,491,298, and the new ownership will be 679,852,000. So this is going to result in selling of roughly $1.8 billion. So this much is going to be sold from the DIA ETF. If we measure how much this will impact Apple's stock price, it won't be much because Apple's market cap is 1.9 trillion. Okay, so the actual impact of selling all these shares on the stock will be 0.095%. So might have a slight impact because of the Dow. Does not appear to be a material effect. So what does it mean for Apple? And the bottom line is not much at all. I mean, maybe you're going to get a little selling pressure from the Dow, the DIA, and maybe you'll get a slight bump in retail interest, but with fractional shares being so widely available, just does not seem to have the same positive effect that it once did. The same positive effect that research from '96 implies. So if you own Apple, I don't know that you would sell it because of the stock split. You could sell it for other reasons. If you don't own Apple, don't know if you would want to buy it because of the stock split. Always do fundamental analysis, valuation, buy because you like the business and you like the price you're paying for that business. Don't buy because of stock splits or lack thereof. It's really more or less completely irrelevant, except for potentially a small impact from indices like the Dow that are weighted by price. Other than that, there really is should be no effect in today's market with today's technology. So hope that was helpful. Hope that answered your question, Eric. If you guys have any other questions you'd like me to answer, just post in the comment section down below. Hopefully I can get to as many of those as I possibly can. If you liked this video, hit the thumbs up button. If you want to subscribe to the channel to get updates on new videos, you can click the red button down below, or I'll post a link somewhere on the screen. Thanks for watching, and you guys have a great rest of your week.